Hi, this is Dustin with Dustin's Dollars. Today, I'm going to be talking about a little bit of education, price to earnings, price to sales, how to use them, how not to use them. And I'm going to be using Palantir and a couple other companies as examples as I just go through to understand this. And partially, I mentioned Palantir because this came about from, I got a little bit annoyed recently at a number of comments that I've seen online. I follow a lot of financial social media posts, and I've seen a lot recently where the narrative is, Palantir trades at a price of sales of 40, 41, whatever it's at right at the moment, and that's just an absolute ridiculous valuation. It's got to come down to half of that or a quarter of that to even be in the ballpark of reasonable. People will say, like, again, I can scroll here right on Yahoo Finance and see their price to earnings is right here, PE ratio 252 according to Yahoo Finance. I didn't calculate that myself, but it's probably in the ballpark of correct. And people say that's a ridiculous number. Or some people would use this. I actually had one person at the end of 2023 explain to me why, or explain online, I should say, not necessarily directly to me, that some other company was trading at a 200 price to earnings, and therefore I think Palantir is going to get to this amount of earnings next year, and I think they should trade also at a 200 price to earnings. Therefore, that would put Palantir at, whatever price. And these are not, in my sort of the way that I view things, I don't think that's a good application of price to earnings. And I'm going to get through some of the details today and explain that. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I do hold long positions in a number of companies, in particular, the ones that I know I'm going to talk about today. I hold a long position in Palantir. I'll try to disclose that if I mention any other stocks that I also hold a position in. But this video should be for your entertainment purposes only, because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. I will amend that today to say that's my standard disclaimer. And today I am trying to share with you what I know. Again, use the caveat that I'm not a financial professional, but I think I've been around long enough to have kind of understood a little bit and to have opinions on when some other folks are misusing certain, valuation ratios that I'm going to talk about today. So let's get into it. And real quick, I'm going to go through sort of the definition and talk about pros and cons, or a bit of caveats with some of these metrics. I'm going to start with price of sales because that's one of the easiest to understand, right? So price of sales, just at the top level, we could look at Palantir while I'm talking here. Price of sales at the, the numerator of that ratio is just how much is the company actually worth? How much is its stock worth, more to the point? And so this is just the number of shares they have outstanding multiplied by the last trading price that they closed at, right? For Palantir, they have somewhere, I'm ballparking it here, I guess we could scroll if we really want, but somewhere around 2 billion shares outstanding, I think, and they trading at a roughly $43. And so that would put them, maybe it's $2.5 billion. And the market cap, is right here is 96 billion. And, that's really what it is. I don't know how many shares are outstanding. It's probably somewhere down here. There we go. Shares outstanding, 2.14 billion. So hopefully if you multiply 2.14 billion by 43, you should get, 96.23 billion. And that is Palantir's market cap. And that's the top on that price to sales ratio and also the price to earnings ratio. So it's basically, intuition should be roughly how much are folks paying for the company's stock if you were to buy all the stock that's outstanding at the current price. Now, the denominator here, the thing you're dividing that price by, is just simply the revenue of the company, right? How much money are they actually bringing in from customers? This is not profit, this is just total revenue, right? So, for example, to give you maybe a simpler example rather than Palantir, imagine a car company. If they sell 1 million cars and each car costs $50,000, that would be, if you multiply that out, $50 billion of revenue that's coming in. So hopefully that's easy to understand. You just divide the price by the revenue, and you get that price to sales ratio. And for Palantir, this is what I mentioned. You can look at this and see their price of sales. It's right here on this row. It's currently Palantir is currently trading at roughly a 41 price of sales, and so that means what you're paying for the stock right now would take them 41 years in order to just bring in enough money to basically pay back. I should say payback is not really the right term, but even to bring in through the front door the amount of money that you're currently paying for the stock. And there's a number of pros and cons to this one. The pro for this one is that it's simple to understand, and you can actually use it to compare companies that have a lot of similarities. And I'll get through that a little bit later. But there's a number of drawbacks to this one. And this is where any attempt really to just look at a company, state a price of sales and say that's overvalued or even undervalued, I think is way, way, way too simplistic. One of the big drawbacks of this metric, and it's true also for, price to earnings, is really that these are metrics that look at the past, right? This is telling you versus what the company has done in the past, how is it being valued? And that's certainly a useful indicator, but the stock market and really what you should be interested in if you are trying to value a company is what are they going to do in the future, right? You know what they've done in the past, and that's good, and that gives you a good, indication of what they might do in the future. But the market is very forward-looking, and so to look at what the valuation, or to determine the valuation of the company, you need to be looking for the future, right? And so that's a humongous drawback for both price of sales and price to earnings. One of the other issues with price of sales is this doesn't work at all if the company isn't yet making money. And I've done videos in the past on a number of viewers on my channel have seen Tellurian or Next Decade. Those are companies that are, of course, Tellurian's been acquired now, but at the time, they were looking to build these LNG export facilities. They had no facility yet, but the company existed. It had a plan. It had some assets that were of value, some of this, the land and the actual project plans for these, and, some sales agreements, right? Those things have value. And so just looking at price of sales, if you say, well, they're not making any money, therefore they're worth, zero, is too simplistic. And then another issue with price of sales in particular is it is not a measure of profit. It's only a measure of revenue, right? So if I go back to that example of a car company that maybe sells, a million cars per year, and they sell at a sales price of $50,000 per car, they bring in $50 billion. What if they only actually make $50 in profit per car? Not $50,000, but $50 of profit per car, right? They have really thin margins on those cars. Well, even though they're bringing in $50 billion in revenue, they're only making, if I can do the math here, I think that's $50 million in profit, right? And so you might have a very, very low price of sales for that company versus another one that is able to sell a million cars for $50,000 each, but their sort of final profit after paying all of their expenses is $10,000 per car. And so now they're actually bringing in, what's that, $10 billion in profit in total per year. And so, those are gigantic differences in sort of how much money actually can flow through to shareholders. And so that's why, price of sales is a metric that has some use, but it's limited. To address that issue of it doesn't really talk about profit, a lot of people will use the price to earnings, right? And so price to earnings is very similar, except the thing that you're dividing by is not the total revenue. It's what is the earnings of the company. And earnings is generally a measure of profit, right? To be more particular or more specific, this is often called net income in terms if you're reading through a company's actual financial statements. And net income or earnings is, sort of the top line revenue that you bring in, subtract off all the costs of actually directly bringing in that revenue, right? So if it was a car company, this would be things like, what did we pay for the raw materials, all the steel that went into that car? What did it cost, all the people that we paid in our factories to actually assemble and make those cars? Then you get down to sort of what you would call a gross profit for a company. And then after that, you pay off a bunch of other things, or you have other costs for the company, which is things like how much did we end up paying our engineers that did the R&D to actually design the car model up front. This is not to actually manufacture the cars, but to just the design so that they knew what they were going to manufacture. And they'll pay off things like their facilities that they have to actually build the cars, because that's not necessarily something that's sometimes that's included in their directly in their the costs that come off of their top line. Sometimes it's after that, but you have other costs like if they're a public company, the accounting department, right? The accounting department is not helping build cars, but they're still included. How much do they pay to actually get some salespeople in there, right? What about overhead? The management, the CEO, all those folks, they get paid, and so those are costs to the company. So after you pay all those things, that's when, and more, right? This is not a comprehensive list, but I'm just trying to give you some examples of all the things that get taken out before you then get your, what you call your bottom line, which is your net income and your earnings, right? And so that's all just to say that earnings is a measure of profit for the company. And so price to earnings is giving you a general measure of how much are you paying for the profits that a company is bringing in, right? And so when I mentioned earlier, if you had two car companies, one of them making $10 billion in profit, one of them making, what did I say, $5 million in profit, they're probably valued significantly differently, where the one that's bringing $10 billion of profit, of earnings, is probably valued a lot more because investors are going to pay a lot more for a company that brings in $10 billion that it could send out to shareholders in the form of dividends or share buybacks versus the one that only brings in $5 million. And so that's where price to earnings is a decent ratio. And this is a fairly common and well-known ratio that most people who are into stocks have already heard about. But there are some significant caveats and drawbacks to price to earnings. Some of them are the same as what I already mentioned for price to sales, right? First of all, once again, price to earnings looks at the past, and there are folks, you can even see it right here on Yahoo Finance. They have trailing PE, which is the price to earnings of the last 4 quarters, right? The prior year. But then you also have forward PE, which is what do we think, at the current price and the earnings that we expect the company to have over the next 12 months, what is that price to earnings? And so that's, marginally better than the trailing price to earnings because it sort of takes into account 1 year's worth of expected growth and expected profitability. But the downside to that is there's 2 downsides. Number one, nobody really knows what they're going to do in the next year, right? We have forecasts, but that's hard to forecast. If everybody had perfect forecasts, it'd be a heck of a lot easier to invest. But then the second issue is this still only looks 1 year into the future. And I'm going to go back to, again, my example of, Next Decade or Tellurian, right? These companies that are building facilities that will bring in profits in the future. Looking forward even 1 year is insufficient for that. Or a company, again, I'm going to call out Palantir here, that is growing, that has accelerating growth actually, right? They were growing 15% per year. Now it's at mid 20s. And if they accelerate it up to 30, mid 30s and maybe even 40 or 50%, year after year after year, only looking forward 1 year is not giving them enough credit, in my opinion, for how do we value this company's future growth. And so that's a major drawback to using the price to earnings to value these companies, is that, the stock markets and their valuations are going to be looking into the future as far as they really need to understand what is the present day value of this company when I look at all of what this company is going to do in the future. And I'm not going to get into, how you do all of that today. I will, I'll just say, if you want to know the bottom line, in the better tool to use if you want to look at this thing is a discounted cash flow valuation. I'm not going to go through that today because that's a very, very much more complicated model to use. And I'll use a simplified version of discounted cash flow valuations in a lot of my videos. But the point is, you need to look more than just 1 year in the future for a lot of these companies. Now, there's some other caveats I would say with price to earnings, and that is earnings can have a lot of adjustments, right? There can be one-off items that impact this, and this can be true for sales as well. A lot of companies in 2020, 2021 had impacts due to the pandemic, and they would argue, or they could credibly say that, oh, for this particular year, our sales are down or our profits are down because, the popular term, everybody, or the excuse you heard a lot of companies saying that was true for some and let's say less true for others, were things like, supply chain constraints back in when a lot of companies were impacted by the pandemic. And there were, other issues ongoing where they might say, that's a one-off issue. That's not going to impact us next year or the year after or anything in the future. So even though our earnings went down, our sales went down, we expect that just be a blip that then reverts back to how it was beforehand, for most of the future and for all of the future, maybe at some points. And so that's a major downside to these metrics, which is, company has one bad quarter, and now all of a sudden the price to sales and price to earnings ratios might look like that company is massively, like a lot more richly valued than they were immediately prior to those quarterly results. But sometimes those truly are only one-time issues, and companies will. This is where companies will say, "Oh, well, instead of reporting, we're going to report our standard earnings, our GAAP earnings, right? You see that GAAP, that generally accepted accounting principles earnings, where they sort of follow all the rules. But then they'll say, you know what? But some of these were only one-time items, like, hey, we laid off some people and we had to pay them out a bunch of severance, right? We're not going to have to pay out severance every quarter. That would only happen this one quarter, and so they might report adjusted earnings, right? And so they'll say our actual earnings were $5 million, but we paid out $5 million of severance this quarter. So our adjusted earnings are actually $10 million, because if we didn't have to pay out all those severance, as we're not going to have to any quarter in the future, we would have made $10 million in profits, in net income. And so that's another caveat that you have with these metrics. Another gigantic metric, a gigantic issue that I have with price to earnings as a metric is for companies that are just finally reaching profitability, right? They've been unprofitable from the start. Lots of companies have to actually spend money before they can make enough money to become profitable. And, when they just tick over that threshold of being profitable, they only have a small amounts of, maybe on a trailing 12-month basis, maybe they only have one profitable quarter or two profitable quarters, or even if they have 4 full quarters of profit, like, they're still ramping up and they're still sort of gaining the benefits of the scale that they have in their business. And I'd say Palantir is a really great example of this, where if you look, you can see their, let's go to their financials here, and look at this. You know what? Here, I've got a better one. I was going to make some charts here just right on the fly. And so let's add on, bear with me for a moment. I'm going to make a chart that really illustrates what this looks like when a company is just reaching profitability. And so we're going to go to revenue. If I can get revenue on here, and then we're going to go to gross profit. This will be on I'll do a trailing 12-month basis. And then we're going to go to, net income, right? And so this is earnings, as I've been talking about. And if we scroll down here so I can actually see the chart, you know what? We don't need price on there. We don't need the stock price for this one. We're just looking at the actual results of the company. You can see the company's revenue, this purple line, was growing quarter over quarter, right? Every quarter it kind of goes up, and that's just been growing since 2019, right? This is a 5-year chart. You can see their gross profit, right? They've had pretty stable margins here. It's been, 80% roughly in that ballpark for the whole time. And so their gross profit has gone up. But their net income, because of that, they also have these expenses. Maybe if I could go to operating expenses, total operating expenses. Let's see if this charts it properly for me. Yeah, so you see their total operating expenses is this green line here. And for Palantir, their operating expenses were higher than their gross profit, right? The green line is above the orange line. And so that's why for a number of years, they were still not profitable. They did not have positive earnings. They had negative earnings. They were actually burning money. And when you look at this over time, you can see, well, their gross profit kept going up. And sooner or later, that gross profit was above their operating expenses. And that's where you see this blue line here, which is a measure of their net income. You can see this was this gray line here, and sorry, it might be a little bit hard for you to see. This gray line right here in the middle of the graph is 0. And you can see it was below 0, so it was negative for 2020 when they initially became public, 2021, 2022, but then it started growing as that orange line, right? Their gross profit was increasing, but their operating expenses were relatively flat. And so expenses stayed flat, gross profit kept going up. Sooner or later, gross profit goes up enough to where now they are profitable. And so you see this net income starts to go up and up and up, and it crosses over 0, and now it's positive. But, if you look at the trend here, and I'm not saying it's going to happen exactly this way, but if you extrapolate this even a little bit into the future, you can say, gross profit seems to be going up much faster than operating expenses. And that's why, I could add on another series here to show you, let's say, net income margin, if they have this. They don't have it. Profit margin maybe is what they call it. Profit margin. Yeah, so if we go to profit margin, go to annual to match all the rest of the series that we have on this chart. That's this pink line. And I know the chart's starting to get a little busy. Maybe let me take off revenue, take off gross profit. But you can see here, now you can see a little bit better. This blue line on this chart is their actual profit margin as a percent. And you can see it was negative. This is going through this, it's going to the second right axis over here. You know what? Let me just get off of, hide all of these other ones so we can just look at the profit margin. So hopefully, if you looked at that last chart, you saw sort of flat operating expenses and gross profit going up. And now you can see as a percentage what their profit margins actually look like. And it was negative and negative until it crossed over this threshold just recently, and now it's positive, right? And so this profit margin keeps going up. And so as they make more money, right, they bring in more revenue, their margins are actually expanding. It's not like their margins are flat. And so, if their margins were a flat line here, and let's say it was just sitting at 9%, or just make the math easy at 10%, that would indicate that, if they double their revenue, their profit would double. But because what we see here is different, what we see here is that their profit margin as a percent is actually increasing over time, right? Because their gross profit is going up faster than their operating expenses. What we should expect is if they double their revenue, they're going to more than double their profit. And so, maybe it will go up from 10% to 20% margins. And if that happened, when they double their revenue, then their profit margin, right, their earnings would quadruple. And this is where things like, I'm going to go back and talk about price to earnings and price to sales. These metrics don't capture some of these more complex aspects when you're looking at the financials of a company to say, as they grow, what is happening to their margins, right? What do we think is even going to happen to the margins in the future? And this is why you have to look further, more than just 1 year into the future, and just extrapolate small bits. Because between here and a year from now, is their profit margin going to drastically change from 10% to 30%? Probably not. I mean, it's possible, but probably not. That would be a gigantic leap. But over the next 5 years, over the next 10 years, if you have a company that is this scalable, right? I'm going to go back and show that what I think is a very beautiful graph of operating expenses versus gross profit, where operating expenses is, fairly flat. The orange line here, fairly flat, while the gross profit just continues going up and up and up, and is even accelerating at this point. What are their profit margins going to look like 5 years from now or 10 years from now as a percentage? Could it be 30%, 40%, 50%? I mean, those are all possibilities. And the implications for the valuation are huge, or the implications for, the profit that they can bring in the future, right? That's really, really huge. And so that's where, I'm getting back to my original, I didn't mean to make a clickbait title, but because I want to talk more about what these metrics are and mean, and some of the caveats, but I do want to tie it back to a real example, and that is, Palantir here, because I read so much of people saying, 41 price to sales is ridiculous. But, I could compare some companies, and I actually had a couple jotted down here that would make sense. So let me do that real quick, and we could look at, we could just take a quick look. I'm going to do 3 different companies because they illustrate this pretty well. I will look at Palantir. I'm going to look at Altria Group, and I'm going to look at, what else did I pick here? I think Target. As 3 companies that are fairly similar in market cap, right? So Palantir is sitting here at, let me go to the summary tab. We'll open. I clicked on it. Why is it not moving? There it goes. Okay, so the summary tab, I think Palantir is at, where is the market cap? Market cap, $96 billion. Okay. Altria Group. This is a company, if you're not familiar with them, they make, they sell cigarettes basically. And you look at their, I wanted the summary tab on this one also. go to Altria Group, scroll down here, look at their market cap, $84.6 billion. So they're similar to Palantir in terms of, what is the company actually valued at? What is their stock valued at? Let's go to Target. Target, if we look at this one, Target, hopefully you're familiar with them. They're a retail company. They have stores all around. They're at $72.2 billion, right? So these are all pretty close. They're within 20-30% of each other in terms of market cap. It's not like I'm comparing a $1 trillion company and a $100 billion company or a $1 billion company. Right? These are all fairly close to each other in market cap. But if we look at some of their valuations, we can see, Palantir, as I mentioned, is at a roughly, we'll just call it 250 price to earnings ratio. So it's very high. Let's go look at Target, right? Target is trading at a 16 price to earnings. So drastically less. I think this is where people would, rule of thumb, lots of times people would say, maybe 10 to 15 is the standard range for a lot of companies, price to earnings, maybe even 10 to 20, you might say. Somewhere in that vicinity. So a lot of people might just look at this at a super quick glance and say, you know what, Target is roughly fairly valued. And then let's look at Altria Group, right? They sell cigarettes, and their price to earnings ratio is currently at 8.5. And so a lot of people look at this, and I picked these three companies because I know that there are various folks who actually, currently are bullish on these companies, right? They think that these companies are good investments. And I'm not making any recommendations here. I'm holding my opinions to myself on these. But I know different folks are saying, Altria Group, it's 8.5 price to earnings. That's a value stock. It's bound to, to go up in the future just because it's so cheap, right? And if the company just continues operating as they are, they'll eventually be able to return so much money to me as a shareholder. I'm going to make a ton of money off of this, right? And they pay a dividend. And so somebody might buy this and say it's so cheap right now. It really doesn't have to. It's probably not going to drop anymore because it's already so cheap. And if they just keep paying that dividend, maybe this will be a really good investment into the future. That's possible. But I wanted to, just look at this and talk about why might these companies be valued this way. And a lot of it comes down to what I said before, which is the future growth of each of these companies in terms of their earnings, right? Palantir, relative to their total addressable market, has only captured a small portion of the market. Palantir's profit margins, as I mentioned before, are continuing to go up as time goes on. As they grow, they're actually capturing more and more of the new revenue that they make as profit. And so that factors into them being valued higher. Altria Group has not been growing. Let's look at their revenue growth. If I just look at Altria Group on here and pull up, let's just compare revenue between these two companies. And we can look at this and sort of see, well, they're on different scales. So let me just take Palantir off of here. We'll look at a 10-year chart for them. We don't need to look at, decades and decades. 10 years is sufficient. But you can see, between 2015 to 2024, they've gone up from roughly 18 billion to 20.5 billion, right? So they've grown about 10% over 10 years. Not 10% per year, just 10% in 10 years. And they're even declining, right? Since 2021, looks like roughly 2021, maybe 2022, their revenues are actually coming down. As opposed to Palantir, that's just growing and growing and growing. And, every indication, quantitatively, and if you look at, look further into the stock, in my opinion, qualitatively, it looks like they have quite a bit of runway to continue growing, whereas Altria Group is not. And that contributes a whole ton into why Altria Group is trading at, an 8.5 price to earnings. When we talk to price to sales, and let me go into the sort of the statistics tab here so I can see, sort of to show you the current point in time, what these companies have traded at. I think that Palantir is already, said that one already, it's at a 41 price to sales. Target, well, let's look at Altria Group, and they are trading at price to sales of about 4.3, it looks like. And Target, you might think, well, they're growing a little faster than Altria Group. I didn't show it on here, but I think they are. they are still, expanding to some degree, and sales are going up. Yeah, they've gone up. That's not revenue. That's not what I thought it was. Sorry. But if we look at their price of sales, they trade at less than 1, right at a 0.68. And why is that? Well, let's go over here and look. Let's just compare. Can we get gross profit margin on here? It's gross profit margin. Hopefully that's as a percent. And we are also going to add on target. So we can compare these three companies and look at this other metric that sort of is a big thing that factors into what is even a reasonable range for price of sales or price of earnings for these companies, especially on the price of sales front. So let me take off revenue and just look at gross profit margin. You can see Palantir is pretty high, at about 80%. You can see Altria Group is, around 70%. That's pretty healthy. Target is all the way down here at 28%. And then if we go to just profit margin, not even gross profit margin, right? So this is after they pay for all their sales and marketing, general administrative, some other stuff. You can see, Target is at a 3.85% profit margin. Palantir is already 3 times that, even though they've just become a profitable company. And Altria Group is much higher. They have a healthy net income margin. At 39%, that's pretty good. Again, the issue I think with Altria Group, a lot of people would point to and say why their valuation is as cheap as it is, right, at 8.5 PE, is because they just aren't growing their top line and they don't have really a whole lot of opportunities to do so. Whereas Palantir, their margins are expanding; they're already higher than Target, and so that clearly contributes as a why you would look at different price of sale, even total ranges of price of sales for Palantir versus Target, because the potential profit margin that these companies can come up with is they're not even in the same league. Target is, if they got to, 10%, if they got up to this 9%, that would be a massive expansion in their margin. We're talking that would be a Herculean effort probably. Whereas Palantir is already there and they're just going to naturally continue growing because they're software, right? It's a totally different business model, and their expense structure is not the same. And so if you look at price to sales, that is a humongous difference between companies that just is not described when you look at price to sales. That's why you can see something where, Target trades at a 0.68 and Palantir trades at a 41. And I'm not going to say that Target is, over or undervalued or Palantir for that matter, but, clearly the market has priced them at least in these ranges, and it's not ridiculous for Palantir to have a price to earnings that's 50 times, price of sales is 50 times higher than Target. They just have massively different profit potential for the amount of revenue that they bring in, and so I'm coming back to this, sort of the original comments that made me really think this through, that a lot of people are just totally missing the nuance in these ratios, is that these ratios, they're a very, very simple look at these companies. There are so many factors that they don't take into account. Maybe a good analogy might be like getting a 1-sentence description of a book and then deciding if it's a good book or not. Like if somebody said, hey, here, Romeo and Juliet, what's that about? Well, it's two young people from rival families that, fall in love and ends in a tragedy, right? Are you going to make a judgment on, is Romeo and Juliet a great play or not? A great story? Well, you don't really have enough information. It's obviously a classic, but, just from that one sentence, you just don't have enough information. You can make a judgment based off of that, but you're not really making a very informed judgment. And that's kind of what I take away from folks who really look at these things and they say, oh, price to earnings is this, therefore that means, therefore here's a conclusion. Or price of sales is this, therefore here's a conclusion. This is true for pretty much most just simple metrics that you make about a company. I mean, they're just way too simplistic to actually tell the full story. And so, when might these be useful? I will give some credit to these things. These are useful when you want to compare very similar companies that are at sort of the same stage of their life cycle. Are they startups? Are they, you can compare 2 early stage startups that are growing at similar rates, maybe with a price of sales. or you could compare to, if I was to compare, let's say, Target and Walmart, right? I actually don't know those companies particularly well. Let's just assume their growth rates are fairly similar. Let's assume that their cost structures are similar. In that case, comparing them on a valuation basis using a price to earnings might make sense because they're in similar industries. They have similar cost structures. If they're, I'm not going to say that they're exactly a similar size. I think Walmart is, like 5x larger than Target or in that vicinity. But, they're not so far apart that you can't use a similar, you could probably use price to earnings to compare them. Price to sales maybe even as well if they have similar profit margins. But, if I'm just going to pick a company, some random company and say, well, their price to earnings is 10 or their price to earnings is 55, and therefore I can say if the price to earnings is 10, they're undervalued. If the price to earnings is 55, they're overvalued, or 200 for that matter, they're overvalued. Like, it just doesn't tell the full story. You have to really dig in. And so this can be used if you do want to compare two very similar companies and say, well, that one seems like it's a much better deal than this other one because, hypothetically, Target has a price to earnings of 16. If Walmart has a price to earnings of 50, you might say, well, why is that? Maybe that means that Target is undervalued, or maybe it means that Walmart is overvalued. Another thing that you can use these metrics for, and this is the way that I personally use them, is, well, I guess two ways. One is as a sort of a screening tool, right? You can look at these if you are looking at more mature companies. You can look at price to earnings just to give you a ballpark, and in particular, you can look at a lot of price to earnings for companies if you can get a screener that will do this versus their historical price to earnings. And that's a little hard to do, but it's something I will do after I get sort of an initial look at a company. I'll look at what are they trading at today versus what were they trading at, 2 years ago, 5 years ago, in terms of, at that time, what was their price, and at that time, what was their earnings, right? And so you can see this even here in Yahoo Finance, give you a little bit of it where you can say the trailing price to earnings. This only goes back over, looks like about a year. I think if you pay for the premium subscription, you can do better. I guess maybe over here I can probably find the price to earnings, yeah, PE ratio. So I guess you could chart it right here, and I could look at this over time. Let me take off Palantir because they don't have that much history. But if I looked at 10 years, and you could look at this at take off that series right here, and we see that Altria Group at some points, presumably when they had some one-off issues due to the pandemic, maybe their PE ratio is high. But you can see right now, if I look at price to earnings for Altria in 2024 versus what they were in 2016, you can see that it's significantly lower than what it was. And you might want to look and see, why did it drop so much at this point in time? Why did it drop so much at this point in time? Those are interesting decision points to go back and understand. Why did the market decide that now we're going to re-rate the stock higher or lower? So that's one way that I will use this. Another way that I will use this is as I do project into the future. If I don't want to do a full DCF, I don't want to do a full discounted cash flow valuation on certain stocks. I just want to get a quick idea of, hey, if I project forward, let's say 10 years or 8 years or something for, a company like Palantir, because I think maybe 8 years from now, we'll get a much better picture of what their earnings might be. And what I will use these, simple metrics for price to earnings at that point is to say, what? It's highly unlikely that if this is a good company, they grow to this valuation that I think is credible, or sorry, this, sort of amount of revenue and earnings that I think is credible. Then once you get to that point, 8 years from now, the stock is probably going to be valued at least at a sort of average general fair value that, people would use for the full market. And let's say that's, 15 PE or 20 PE, whatever you think is a sort of just general fair value for a stock. And so I will sometimes project into the future, 5 years, 10 years, and then really look at it and say, just as a ballpark, if I don't want to do my full DCF at that point, what would the stock be worth if it were valued at a 20 price to earnings? And that sort of gives me a floor price where I think, the market is highly unlikely to value it lower than this price to earnings. So now my job becomes trying to forecast what might their earnings be. And so if I have a decent idea of what I think their earnings might be, 5 years or 8 years in the future, then I can look at that and I can say, well, if they have this price earnings and this amount of earnings, you just do the math and you can say that means that the stock will be valued at this particular amount. And so I will use that to sort of look into the future to give myself just a quick idea of how things might be in the future. And again, I think it's not as robust as using a full discounted cash flow valuation even at that point, but I think it can be useful for that sort of a model. So that's kind of where I come at these things at. To directly answer the question, since I did put it in the title as Palantir overvalued. Short term, no one can predict the moves of the stock. I think anybody who thinks that they can is a fool. I certainly can't. Long term, it's hard to say. Let's say medium term, right? In the next 2 to 3 years, Palantir has run up a lot. I'm not going to lie to you. It has a lot of hype behind it. At the same time, a lot of that hype is warranted. I think the company has they have some advantages, let's say, over other companies. They have a massive, addressable market. They are, they have the right product at the right time, as I say. And it's not impossible that, Palantir is going to accelerate their growth enough to where people would look back on today and say, yes, a 41 price to sales was actually a decent value. And I could give you an example here, and I know everybody's probably gonna laugh or maybe criticize me, but let's just look at Nvidia and look at their price to sales. I think I can add this on as a metric here. Price to sales ratio. Take off the price to earnings, and let's look at Nvidia over the past 5 years. And we can see there was this massive spike where, Nvidia was valued at a price to sales of, 40 something, 45, let's say maybe, because I think this gray line is 36. This one up here will be 48. So maybe it's about a 45 in, roughly the middle of 2023. Let me add on one more. And so if you bought there at a 45 price to sales, which again is slightly higher than where Palantir is at right now, what would have happened to your investment? Well, let's add on the actual stock price, and you say, well, this orange line here is their price to sales. That was where it was at roughly a 45 price to sales ratio. Well, if you go down here and look at the purple line, the stock was trading, again, this is, I think, before these are using prices that are split adjusted. But if you look at it in today's prices per share, you would have bought around $45, maybe $50 per share. And today that's worth $138, roughly a year later. So, was it undervalued or overvalued? Clearly the market as of today is telling you at that point in time, a 45 price of sales was a pretty good price because you would have more than doubled your money since it, almost tripled your money. And so is that also the case for Palantir? Are they going to put up numbers that look like Nvidia? I don't know. It's possible. It's I'm not going to say it's likely, I think, but there's a lot of tailwinds that they have, a lot of advantages. And so it's way too simplistic to just look at this metric and say, 41 price of sales, massively overvalued. This is ridiculous. And yeah, I will leave it at that. And just to say, the conclusion is, could you have something similar happen with Palantir? You could. On the flip side, have there been other companies that traded at a price of sales this high and then came way back down to reality and never reached those prices again for a decade or more? Yes, you just look at Intel in the early 2000s. You probably pop that one on here just as the sort of the other side of the coin. I know maybe it's a little bit. I don't want to say ironic. I'm not sure that that's the right word, but a little funny that I'm using two sort of semiconductor companies. If you look at Intel, their price of sales was way high back right around the year 2000, 2001. And if you would have bought, that purple line here, it would have went down and you did not recover your money for quite a while, right? They didn't, the growth that the market thought was going to materialize did not grow, the growth in earnings, that is. And so that's the flip side. That's the other possibility that could happen. So maybe the people who are saying Palantir is overvalued are right. But again, maybe they're right, but just because Palantir is trading at a price to sales of 41 is not a sufficient basis to sort of have form a strong conclusion. So hopefully that is helpful for somebody out there. If you have any questions, feel free to reach out to me either on Twitter or in the YouTube comments here. I try to respond to any questions that I get. So, all right, I will hop off now. Thank you very much for watching. Have a good one.